What's the one thing that scares people away from investing? Is it the jargon, the numbers, or is it the risk? Let's be real. It's often the last one. The concept of risk is a cornerstone in the world of investing. It's that scary word that makes your heart race and your palms sweat. But what if we told you that understanding risks is not as daunting as it sounds? You see, there are different types of investment risks. Market risks, for instance, are tied to the overall economy. Then there's credit risk, the possibility that the entity you've invested in might default. Liquidity risks come into play when you can't easily sell an investment without affecting its price. And let's not forget operational risks, the potential for failures in a company's day-to-day operations. These risks might sound intimidating, but remember, knowledge is power. No matter the type of risk, the key here is understanding them and knowing how to navigate through them. Before we continue, don't forget to smash that like button, hit the subscribe button, and turn on notifications so you don't miss our next awesome video. Drop a comment below to share your thoughts or any topics you'd love to see in future videos. Consider John, a young professional who invested heavily in tech stocks in the late 1990s. He was riding high on the wave of technological innovation, with the internet promising to revolutionize the world as we know it. Investing in tech seemed like a sure bet. After all, who wouldn't want a piece of this burgeoning digital pie? But John's story takes a turn for the worse with the advent of the dot-com bubble. This was a period of extreme growth in the usage and adaptation of the internet, which led to an astronomical rise in tech stock prices. But just like any bubble, it was bound to burst. And when it did, the market came crashing down, taking John's investments along with it. John had fallen victim to what we call market risk. This is the risk that the value of an investment will decrease due to changes in market factors. In John's case, these factors were the overvaluation of tech stocks and the subsequent market correction. Market risk is a fundamental aspect of investing, and it's something that every investor, no matter how big or small, needs to be aware of. What could John have done differently? Well, one strategy he could have employed is diversification. Instead of putting all his money into tech stocks, he could have spread his investments across a variety of sectors. This way, even if one sector crashes, the others could potentially offset the losses. Diversification is like a safety net for your investments. It won't eliminate risk entirely, but it can certainly help to mitigate it. It's like the old saying goes, don't put all your eggs in one basket. John, unfortunately, learned this the hard way. John's story serves as a stark reminder of the dangers of market risk. It's a cautionary tale that highlights the importance of understanding the market and the risks associated with it. So, before you make your next investment, remember to consider the market risks and how you can mitigate them. John learned the hard way that putting all your eggs in one basket, or in his case, one sector, can be a risky move. Now meet Sarah, who invested in corporate bonds from a company that later filed for bankruptcy. Sarah, like many others, was attracted to the high interest rate promised by the bonds. She thought it was a golden opportunity to grow her investment portfolio. But little did she know that she was stepping into the realm of credit risk. So, what's credit risk? Simply put, it's the danger that the company or government that issued the bond might not be able to pay back the principal or interest. In Sarah's case, the company she invested in fell on hard times and filed for bankruptcy. This meant they could no longer fulfill their obligations to bondholders like Sarah, leading to her losing her investment. But could Sarah have seen this coming? Could she have minimized her losses? The answer is yes. She could have done her homework on the creditworthiness of the company before investing. Creditworthiness is a measure of how likely a borrower is to repay its debts. It's often represented by credit ratings given by credit rating agencies like Standard & Poor's, Moody's, and Fitch. These agencies analyze a company's financial health and assign a rating. The higher the rating, the lower the credit risk. If Sarah had looked into the company's credit rating, she might have noticed that it wasn't as rosy as she thought. She might have seen the warning signs of financial instability, giving her a chance to reconsider her investment. In addition to checking the credit rating, Sarah could have diversified her portfolio. Putting all your eggs in one basket is never a good idea. By spreading her investments across different sectors and types of bonds, she could have reduced the impact of the single investment going sour. Investing is never a sure thing. There are always risks involved. But by doing your due diligence and diversifying your portfolio, you can help cushion the blow if things don't go as planned. Sarah's story is a reminder that not every investment is as secure as it seems. Let's not forget Alex, who bought into a real estate investment trust just before the 2008 financial crisis. Alex was a go-getter, a young professional who was eager to make his mark in the investment world. He had a good job, stable income, and was ready to start building his financial future. He decided to put his money into a real estate investment trust, or RAT, right before the 2008 financial meltdown. On paper, it seemed like a solid move. REITs are companies that own, operate, or finance income, generating real estate, and they are known for delivering high yields. But Alex overlooked one critical factor: liquidity risk. Liquidity risk is the risk that an investor might not be able to buy or sell an investment quickly enough when they wish to do so without causing a significant price movement. When the market crashed in 2008, Alex found himself in this exact predicament. Property values plummeted, and the demand for real estate investments dried up. Alex was stuck with an asset that he could not sell without incurring a significant loss. This is where the importance of a diversified portfolio comes into play. If Alex had spread his investments across different asset classes, the impact of the real estate market crash would have been less severe on his portfolio. Diversification can provide a cushion against the volatility of a single asset class. Additionally, a solid understanding of market conditions would have guided Alex to make more informed decisions. The signs of a looming financial crisis were there, but Alex failed to read them. Had he been more vigilant, he might have held off on his investment or chosen a different asset class altogether. Alex's story is a stark reminder that investment is not just about high returns. It's also about understanding the risks involved, assessing market conditions, and diversifying your portfolio to spread and mitigate potential risks. Alex's experience shows that timing and market understanding are crucial when investing. Emily, an investor in a hedge fund, found herself facing operational risks when fraudulent activities were discovered in the fund. Meet Emily, a savvy investor who decided to take the plunge into the world of hedge funds. Emily had done her homework, or so she thought. She had studied the fund's past performance, its strategies, and even its risk management approach. But what Emily hadn't considered was the possibility of operational risk. The risk of loss resulting from inadequate or failed internal processes, people, and systems. Here's where Emily's story takes a turn. The fund that Emily had invested in was discovered to be involved in fraudulent activities. The management was cooking the books, and the fund's reported performance was far from the reality. This was a classic case of operational risk, something Emily hadn't anticipated. So what could Emily have done differently? Well, the key here is due diligence. It's not just about understanding the fund's strategy or looking at its past performance. It's about digging deeper. It's about knowing who's managing your money and how they're doing it. Emily could have looked into the fund's management, their qualifications, their track record. She could have sought independent reviews or audits of the fund. She could have checked if the fund's management had any history of regulatory issues or legal troubles. All these are red flags that could have alerted Emily to potential operational risks. Moreover, Emily could have paid closer attention to the fund's governance structure. Was there adequate oversight? Were there checks and balances in place to prevent fraudulent activities? These are all questions that Emily could have asked. Emily's experience is a stark reminder of the potential pitfalls of investing. It's a cautionary tale that underscores the importance of thorough research and due diligence. Because when it comes to investing, knowledge is not just power, it's protection. Emily's story underlines the importance of thorough research and due diligence in investment decisions. So how can you avoid falling into the same pitfalls as John, Sarah, Alex, and Emily? Well, let's delve into some expert advice on mitigating investment risks. First things first, diversification. It's like the old saying goes, don't put all your eggs in one basket. Spread your investments across various asset classes such as stocks, bonds, real estate, and commodities. This way, if one sector takes a downturn, your entire portfolio doesn't have to bear the brunt. Next up, research. And no, we're not talking about a quick Google search. We're talking about deep, intensive research. Understand the companies you're investing in, their financial health, the industry they operate in, and their growth potential. Keeping yourself informed will help you make well-informed investment decisions. Then, we have understanding market conditions. The market is like a giant wave. Sometimes it's calm, and sometimes it's tumultuous. Knowing when to ride the wave and when to wait it out is crucial. Keep tabs on economic indicators, policy changes, and global events. These can greatly influence market conditions and, in turn, your investments. Lastly, due diligence. This is the process of thoroughly checking and verifying all aspects of an investment. It's like doing a background check before going on a date. You wouldn't want to invest your time and energy into something that is not worth it, would you? The same applies to investments. Ensure you're investing in a legitimate, financially sound company that aligns with your investment goals. Now, all of this might sound like a lot, and yes, it is. But remember, investing is not a sprint, it's a marathon. It requires patience, discipline, and continuous learning. But the rewards? Well, they can be truly substantial. Remember, knowledge is power. The more you understand about investment risks, the better equipped you'll be to manage them. Investment risks can seem daunting, but they don't have to be. Let's take a moment to recap what we've covered. We've delved into the realities of market and credit risks, two of the most common hurdles investors encounter. We've heard real stories from the financial frontline, like Alex's, whose encounter with market volatility was a wake-up call, and Emily, who faced the harsh realities of credit risk. But remember, it's not all doom and gloom. We've also explored how these risks can be mitigated. It's about understanding the landscape, staying informed, and making calculated decisions. It's about diversifying your portfolio, having a risk tolerance that aligns with your financial goals, and seeking professional advice when needed. Investment risks are a part of the journey, but they need not be roadblocks. Investing always involves risks, but with understanding and careful planning, you can navigate your way to financial success.